Today, what we're transitioning to is talking about business credit with credit banking. So we've been talking about and going over all this stuff on credit banking and eliminating debt. Now I just throw out there business credit. Business credit, what are we talking about now? Business credit is an entirely another strategy, right? Business credit is how you gain access to lines of credit without having to use your social security number or without having to provide a personal guarantee. Business credit is not even what this webinar is usually about. We're always talking about credit banking, but credit banking is such an amazing strategy to eliminate debt and to create wealth that it stands to reason that if you have one awesome financial strategy and you combine it with another awesome financial strategy, you get a truly amazing financial strategy. With credit banking, basic way that a lot of people do it is they use their credit cards, but ultimately we want people using a line of credit, a personal line of credit, a secured line of credit. The creme de la creme would be using a home equity line of credit because they're so large and you've got so much money to work with. Now, for a lot of people, that's not a reality. They just don't have that as an option. They either don't own a home or they have a home, but they're not able to access the equity because they don't qualify. And so this is where business credit is another way to get access to lines of credit. So if you can't access a personal line of credit, a secured line of credit, a home equity line of credit, well, then we need to look at another strategy is what about accessing business credit? And you might be saying to yourself, well, I don't have a business. Well, you need to get a business. Everybody should have a business. There's no excuse not to have a business. Well, I don't know what I should be in business for. And doesn't that cost money? It costs you money to not have a business. Well, I don't have time to talk to you about how much money you are spending in taxes and government fees and regulations. 50% of your annual income is going down that toilet. Toilet, but to the government, okay? If you believe that they're spending your money wisely, then keep going. But the government incentivizes business owners to make money, to employ people, to use products, goods, and services to add to the gross domestic product. And when you do that, they incentivize you by giving you write-offs. So what does that mean? You get to keep more of what you make. So people are like, well, that sounds good, but I don't know what I would do. Well, listen, you were put here for a reason. God put you on this earth for some reason. And you don't have to invent a new widget, right? I'm not saying that you have to start some business or a repair company with your truck and you go out and you fix things. I mean, if that's what you're passionate about, that's what you should do. And that's what your business should be, whatever you're passionate about. I mean, if you like to read and write books, then that should be what your business is. If you like to travel, you're outdoors, whatever it is, that should be what your passion is. But until then, you should start a business and you should start to grow your business. Business credit allows you to grow your business to get access to funds that you can use to grow your business. Now, even while you're still trying to figure out, well, what am I going to do with my business, doesn't mean that you can't lay a foundation, right? I don't know exactly what my house is going to look like. I don't know how I'm going to decorate my bedroom, right? That doesn't mean that we can't start building it, though, right? And so this is what business credit does is you want to be in business to save money in taxes. You want to be in business to create extra streams of income in case your primary job were to go away. What would you do? Well, your business, ultimately, you want to grow it so that it makes so much money that it takes over whatever you're doing for your job, so that you have money coming in that meets your monthly expenses. And with your business, it allows you to just do what you love to do, because you've heard it said, if you do what you love to do, you will never work a day in your life. But how many people are stuck going to a job that they hate? They're like, oh, I'm sick and tired of working here. But, you know, I've got benefits, it pays the bills, so they keep working this job, but they're so unfulfilled because they're not doing what they're doing. When you start a business, you get to follow your passion.
Oh, that's so true, Joseph. And I think a lot of folks think that you don't have to jump into this full time. You start a side hustle, and slowly you'll grow this. And you'll transition. It may take you a couple of years. It doesn't have to be done overnight. And quite frankly, you can't. You just can't. It takes time.
Well, with business credit, though, that doesn't take very long to establish. I mean, you can get $50,000 in as little as 6 months. You could have $150,000 in a year, and that's just from starting a business. And you're like, but I haven't even made any money yet. I know. This is money that's available even for startups. Now, I say all that and you're like, hey, wait a minute, Joseph. I came here to learn about credit banking and reducing my debt and strategies, and you're talking business credit, because we're talking about how do you combine the two. This is an amazing strategy. Let's talk about it. Okay, let's talk about my friend Max. All right. Now, when we talk about business credit, we're going to say Max, he had all those same numbers that we were dealing with last week when we went through the credit banking strategy, right? He's got a $200,000 mortgage on his house that he's been paying on that for 5 years. So it's really more like 189,000. He's got, well, I don't know where he's at, right? You know, you got to find where people are at, but we're using these same numbers, right? And he's got $15,000 credit limits. Let's say that's across 3 different credit cards. So 5,000, 5,000, 5,000. But he's carrying a $12,000 balance. And let's say that's equally spread out on those 3 cards. So 4,000, 4,000, 4,000. Well, his income, as we went through the lines versus loans, and so we know how to use the lines of credit, and we went through our budgeting piece, and we learned how to eliminate the monthly credit card payment, and we've decided not to keep throwing our money away at bad investments. I mean, people have put a lot of money into 401ks and retirements, and they're like, I don't want to stop contributing to that, but it's like polishing brass on the deck of the Titanic while it's sinking. I mean, what is that doing for you, right?
Yeah.
You should be immediately trying to get to a lifeboat. But I mean, when you invest in these 401ks, they again, we talked about the 40-40-40 plan. Traditionally, what happens to most folks is you end up with an amount of money at the end that ends up being about 40%, because you're going to pay yourself out over time, 40% of what you were making when you were just struggling, living paycheck to paycheck, and then you retire and somehow having less money is going to be better. I mean, we need to accelerate the growth of your retirement. And so there is a lot of pushback that I get from people that are like, what? You want? No. The credit banking strategy eliminates debt, and we focus so much on that, but the long-term strategy of credit banking is that it helps you produce wealth. But we really talk a lot more about that on Thursday nights with you.
Right.
but on this Tuesday night, we really focus on how do we eliminate this debt. So here we have Max. And you know what? My voice is starting to go. Can you give me a bottle of water, buddy?
Absolutely.
I appreciate that. So Max, why is he called Max? Because he's maxed out. Can you relate to Max? Do you ever feel like you're maxed out? I mean, for 2 years, he's been maxed out. For 2 years, Max is in a situation where his credit cards are maxed out. He's just in a situation where he wants to do the credit banking strategy. He's seen it, he understands it, but there's a bit of an issue that comes up for him. Now, also because he's been maxed out for so long, his credit score is tanking. His debt to income ratio is unfortunately very high, which means low chance of him qualifying for any more credit. And his utilization's high. And so that's what we're going to talk about right now. The fact that the utilization is so high, thank you so much, sir.
Yes, sir.
It has a huge impact on how he can implement this strategy. So take a look. We talked about $15,000 as a limit. So break that over, say, 3 different credit cards, a Visa, Master, American Express, all with a $5,000 limit, but he's carrying a $4,000 balance. And it's been pretty high like that for, a couple of years. Well, what would happen if Max decided, you know what, I'm going to try this credit banking strategy that I saw Joseph, he instructed last week. He talked about putting all of your income into your lines of credit, freeing up that available credit, and then putting all your expenses there, and then using your cash flow to pay down your debts. So He goes ahead and he tries it. And he puts his $5,000 onto his credit card, and it immediately zeroes out that balance. The $4,000 debt, bam, it's wiped out.
Nice.
But at the same time, the bank responds almost instantaneously. Like you make the payment, and then a billing cycle later, they have lowered your available limit by the same amount. You paid $4,000 on the card, and they lowered your limit by $4,000. I mean, it feels like you just lost money. I mean, in actuality, you still owed the $4,000, so you didn't lose money, but that was your income, and if you put that in there, you were supposed to get available credit back. I mean, that's the beauty of the credit banking strategies. When you put your cash into a line of credit, it returns back to you in another currency, in the currency of available credit. But in this example, it didn't return back to Max. And so this has happened to some folks, and then they get very upset. And they're like, this credit banking strategy doesn't work, and you're full of beep, like they get upset. And then you wonder, why do Ray and Joseph always have to read disclaimers every time before they start, right? Because you need to understand that your individual situation could be different from somebody else. And so if you have credit cards with an available limit and they haven't been maxed out and you're not maxed out, then this is really going to work with you on your credit card. But you've still got to be careful, because if you exceed $50,000, not 50,000, scratch that. If you exceed 50% utilization on your credit cards for any sustained period of time, your credit issuer has the option at their discretion to lower your limit. And so if you're over 50% utilization right now, but let's say you're under 6 months, like it's just been the last couple of months, do everything you can to get that under 50%, because after a 6-month period of time, they're going to really, I mean, what are banks doing right now with the current economic situation, right?
Keeping you trapped. So no, but that is, they're reducing the personal available credit. So if you've had old credit cards, we're seeing those getting closed. We're seeing those limits getting dropped, because on their balance sheets, they're having to free up available capital to fund the paycheck protection programs, the emergency injury disaster relief business loans. I mean, so they're having to free up all this capital so they can start lending it to businesses.
Absolutely. So that's the fortunate place where a lot of people find themselves. And so if you know this ahead of time, then this won't happen to you. But if this is still you, because I mean, here's Max. Look, he's got a house. He's got some equity in his house. But I mean, and a lot of people talk about when we say, don't put all of your money into paying off your house. Someone's like, no, use all of your cash and you pay it down. You lose 100% of your buying power. If you're at all like Max, yes, you're putting your money into your house and you're saying, man, I got equity, but you can't access your equity. There is no access to your equity if you don't qualify. If your credit score is low, debt to income ratio is too high, right? Your utilization is too high. It doesn't matter how much equity you have, you can't borrow against it. The only way to get that equity is to sell the house. But then now you have a new problem. You don't have anywhere to live. So you've got to then go get another house, and then there goes all that equity into the next house. So this is where a lot of people feel completely trapped, and they feel like they're sinking into quicksand. So this is where business credit comes in, because this is where we say, look, okay, you need a line of credit, and you don't have the ability to get one right now because of your credit score. In fact, because of Mac's situation, he can't even get a secured credit card or a secured line of credit because he's too much of a risk, because he's been maxed out for so long. What this tells credit issuers when you are like this is that you don't know how to manage the banking product called credit. You don't know how to do it. So that's why when he made the $4,000 payment, they dropped the limit, because they're like, you have not shown us that you know how to use this responsibly. So we're not going to take a chance on you holding another $4,000 for 2 years, right, out and not paying that back. They want to see you keep your utilization under 30%. That's where they really want you. They're going to start decreasing your limits if you go above 50. But if you keep it under 30% utilization, that's where they want. That's where they want. They want you using the credit every single month. They want you paying your credit down more every month than what you put on it, right? And then they want you to keep that utilization under 30%. If you can follow these rules that are on a credit card, and there's more, but those are the big ones. That's why when we talk about doing a credit banking strategy, it was designed for a line of credit because you love line of credits. They might be at a variable interest rate that's based off of an index, and so you know that it's going to go up, but it's not like the adjustable rate mortgage that's also based on an index plus points, right? So those are always going to be even more expensive. But with a home equity line of credit based off of a variable rate, you're going to be locked into that for 5, 10 years. Usually 10 years is what they lock you into. And then you've got your terms, and you're pretty safe because that is secured by the asset of the house. Whereas with a credit card, there's no security there. It's an unsecured line of credit. So that's why they can change all of the terms on you every month. And if you don't follow all of their rules, and if you've never really gotten educated on credit, then you don't know all the rules, then it's very easy to it's like, officer, I didn't know I was speeding. Oh, well, since you didn't know, I'm not going to give you a ticket. Does it work out that way?
No.
Not usually. No, you're still, so this is why lines of credit are great, because there's actual collateral that holds the line of credit, so it's secured. Unsecured lines of credit, like the credit cards, are something that we have to be very careful with. I mean, you still have to be careful even with a line of credit, because if you don't make your payments on it, you can still lose it. Same thing with a mortgage, though. If you don't make your mortgage payments, they'll foreclose and take it. So, but the thing about with your unsecured line of credit, if your credit score goes too low, your debt to income ratio goes too high, utilization's too high, too many inquiries in a short period of time. I mean, all these things can really jeopardize your ability to use an unsecured line of credit. So that's why you got to be very careful on how you do this. So you can do credit banking with a credit card, but you've just got to know all the rules. You got to read the fine print. And when was the last time you read the fine print on a credit card?
Oh, me?
Yeah.
2 days ago.
Well,
That's
you
me.
read the fine print on not only yours, but you read the fine print on other people's credit cards.
But that's me. I'm weird like that. Now, before we got into this, never. I was like, man, this is a waste of trees. And throw it away. Never looked at it.
Absolutely. All right, so now we're going to talk about, here's a solution. Since we can't access the equity in the house, let's start a business, right? Now, the challenge with starting a business is that businesses, to thrive and succeed, they need three things. They need cash flow, right? There's got to be some kind of revenue coming into the business. Number two, the business needs credit. I mean, you could have, there's three forms of credit. Your personal credit, which is what we're talking about here, but there's also your bank credit, which is something a little bit more secretive, right? Not a lot of people know what their bank credit rating is. And then there's business credit. And a lot of people either think they know what it is, or they were certain that they knew what it was until they say, what's business credit? And then they hem and haw, right? Business credit is credit that you obtain on your business's EIN number, right? This is similar. The EIN number is the tax ID number for the business, just like your social security number is the tax ID number on your personal side. So when we talk, and this is why a lot of people say, well, Joseph, I don't know what kind of business start, because how can my business start making money? Well, folks, listen, there's no shortage of making money out there. There really isn't. There are so many great ways to start a business and start making money within a couple of weeks. There are all kinds of network marketing that's out there, referral-based marketing. There's so many businesses that offer a percentage kickback of whatever the product is that they serve, if you can bring them customers. And you might even see that sometimes, like with your phone bill or your credit bill, they say, hey, if you can add a new client, you know, you get a break in your services next month. You know what I'm talking about? Right?
Oh, yeah, yeah.
I mean, that's a very basic form of it, but business, the fastest way to make money in business is to start a simple referral business. I mean, there's so many different ways that you can go, but if you have an idea for a new potion, lotion, a new patent, you want to put out there a new product you want to bring to market, you've invented a new mousetrap, right? Whatever it is, there's a business opportunity that's out there. Sometimes there's in the service business. You've got a great recipe. You're really good at baking, cooking. You want to start a restaurant, a bakery, a coffee shop. There's a lot of people out there that have dreams and they want to do these things. There is money, there's grants out for a lot of people to start a business that they don't even know about. Everyone thinks that, well, I've got to be independently wealthy to start a business.
Oh, no, not at all.
There's so much seed capital that's out there, even for startups. If you've got a great idea or you've got a successful business model, so it's all meaning somebody else has already done your business model, like say a coffee shop or something like that, and it's working, and you just want to do the same thing, like start a franchise. A lot of franchise owners out there is a great way to start a business. So anyway, folks, you got to start a business, but every business needs cash flow, it needs credit, and it needs collateral. These three things are what give the business its foundation, its financial security, so that it can grow. So there are challenges. So here's the issue. Businesses have those three challenges to overcome. But on your personal side, in Max's situation, he's got his challenges. He's got his debt. He's got his low credit score. His debt, we refer to as debt to income ratio, is too high. Utilization is too high. So we see that there's challenges on his personal side. He can't implement the credit banking strategy because he doesn't have access to a line of credit that will let him utilize the strategy appropriately. So the business has its challenges and Max has his challenges. But now here's something that's interesting. When you build business credit in a business, even as a startup, right? A simple matter, it's very simple to do. Businesses that build business credit, how do they do that? They purchase product and then they get invoiced and then they pay the invoice, and then that positive payment history establishes a track record that gives them credit. And so you can get $50,000 in lines of credit in as little as 6 months, and it could take up to 12 months. But then someone says, well, you talked about making purchases. Well, where are we going to do that? No, well, okay, you got to create synergy. If you start a business, right, there's certain things in your life, like you might have a cell phone, you might have a car, you might have expenses at your house, you need cleaning supplies, you need toilet paper, and whatever it is. You start taking the expenses that are in your life and you begin to convert them into business expenses. There's a lot of things, people are chiming in. Are you chatting with people?
Yeah.
Okay, cool.
That's me.
All right, perfecto. So with your business, all we're trying to do is find legitimate personal expenses and make them into legitimate business expenses. So we're not talking about spending any extra money here. We're just talking about spending the money that you already have to spend every month and converting that into business expenses, write-offs. So not only are you going to be, this is so cool, not only are you going to be growing your business, but you're also going to be getting that money back to you in the form of tax write-offs. Super cool. Starting a business is really, in my opinion, the solution to every financial situation you have. If your taxes are too high, start a business. If you're in too much debt, your debt's too high, start a business, right? If you don't have enough income coming in, start a business, right? If you are looking to build and grow your retirement faster, start a business. Whatever your financial, wherever you're at, business helps you eliminate debt. It helps you pay less in taxes, so you keep more of what you make. It increases your streams of income, and it helps you increase or accelerate your building of your retirement. So with that said, here's how we're going to create some synergy. So with a business that has $50,000 in lines of credit, now these are all kinds of things. We're talking about trade lines, store cards, right? Gas cards. Like, you can't really do, loans with that.
Right.
But let's say half of that is unsecured credit cards for the business. We're talking about a MasterCard, a Visa, American Express, something like that. And so we're going to take $25,000 of the $50K that you built in say 6 to 12 months. And what are we going to do? Well, we're going to take that. Now, these credit cards, corporate credit cards, come at 0% interest for anywhere from 18 to 24 months. So we're going to say, let's say you've got it for 24 months. Okay. Well, what you see here on your screen, and this is just one of many examples. I mean, there are literally dozens of ways to do this. Okay, so some people watch what I have on the screen and they feel like, oh, I've got to do it this exact way. This is one way. Okay, there's totally a number of ways to do this, but here's what you see on your screen. The business takes its lines of credit and it can do one of two things. It can make a loan, like it can just pull the cash out and just straight up loan max the money, or the business credit card could get a credit card. Even though you have a corporate credit card, it could get a credit card in Max's name, right? An authorized user of the card, and extend to Max a line of credit. Now we call that, now the business is going to have to be just as smart as the bank. Everything that we're doing here has to have full documentation, meaning if you have money in one hand, this is your business hand, and this is your personal hand, and you just start lending money back and forth, that's a big problem, because if you get audited and you don't have proper documentation for that, any money that your business gave you personally is going to be considered income for you, and you're going to be taxed on it. So no, we're not going to do that. We're going to document everything. So this is going to be a loan like you would get from a bank. You're actually going to write a private mortgage note. We're talking about setting up a 2-year term, an interest rate, right? And then it's going to be recorded in the business's ledger as a loan, and you're going to receive it as such a loan. So you would not count that as your personal income. This is loan money that you receive that you will have to pay back. Now, making sure that this is all documented, a business that's going to give that kind of loan is not usually going to make a secured, an unsecured loan. It will for a certain amount. Like if your business is just going to lend you, say $5,000 or less, you could do that unsecured. You don't need to put a security instrument in place. But if you're looking for 25,000 in this case or more, right, then the IRS is still going to say, if they were auditing you, why wasn't that secured? That doesn't make sense. That's not a good business choice, right? So that's why you've got to have a security instrument. So since Max has a house and he has equity, for the purpose of our example here, let's assume that Max has, when you do an appraisal of the house, or you might not need to pay for an appraisal, but let's say you call up a realtor and he gives you a BPO, right? A broker's price opinion. Well, that can give you a fairly accurate estimation of what your house is worth today. And if you calculate what you still owe, and if there's a gap of at least, let's say, $25,000, then you still have that first mortgage. We're not touching the first mortgage. We're still going to pay that. But the business is going to lend this line of credit in second position. It's like going to be the second mortgage, right? It's going to be a home equity line of credit. But to make it official, I recommend going through a title company, but you don't have to. You could go down to the county courthouse and file the lien yourself as long as you fill out the right paperwork. But I like the title company because it's a third party, and that it's always good because it gives you it's an extra pair of eyes. There's an independent record of what you're doing.
Mm-hmm. So it's good to use a third party.
So with the title company, they're going to file your lien against the property. Now, the terms that you set up. Now, if you gave this money as a loan, then the title company could service that loan. They could take the payments. They'll come up with the whole amortization schedule for the whole payback. So that's very easy. Now, if you going to extend the line of credit, then this is something that you're going to have to actually hire an accountant to manage the line of credit through like QuickBooks or something like that. You're going to have to manage how the line of credit is used, because the business cannot, if the business extends a line of credit to Max personally, everything that Max pays for on the line of credit on the personal side cannot be a business write-off. because it is a loan. So the only income that the business can claim is the interest that it's charging. Now, that you need to make sure that an accountant verifies all of that, because if you're doing this yourself, it's very easy to miss something, right? There's a lot of moving pieces here, okay? So if it was a loan, then it would look like this. So instead of putting your $5,000 onto the card, Max would then put $5,000. Let's say you put the private mortgage note for 2 years, 30% interest. It's coming out to $500 a month payments, interest only. So Max is putting $500 of his income no longer on his lines of credit, like we taught in the credit banking class. He's now putting his $5,000 into the title company, these payments on the loan, right? So this would be on the HELOC, right? So if you put $5,000 but for a $500 payment, the title company has to extract its fee for processing, right, and then $4,950 then goes to the business. Now that is not income, right? For those who are, if you're following this, but it is revenue. The difference is that money is mostly just loan repayment. He's got to apply almost all of that money towards paying back the credit cards that Max is using. But it is revenue. So there are revenue-based lenders out there, like your merchant service providers are revenue-based lenders. So right off the bat, just by setting things up this way, you've got third party, you've got your private mortgage note, and you're making you've got a $500 minimum payment, but you've got $5,000, so you're overpaying it. So all of that extra money is flowing over to the business as revenue, but most of it is accounted for in the loan repayment. However, there is income there still, 30%, right? Income, but that 30% is an APR that's got to be divided by 12. So really only 2.5% of the actual balance is really being income. So these are things that when you have an accountant, they're gonna take care of.
Yeah, Raul had that question. So if you do it as a loan from the line of credit to the second lien position loan, are you going from simple interest to amortization interest? Well, so is the title company going to amortize it out over the 2 years?
Yeah, the amortization just means how you pay back the principal and the interest. The way that the banks do it with the front loaded, that amortization model, this is not going to follow that model. That's why you see on the private mortgage note, 30%, that's 30% as an APR. I'll update the slide next time and put APR there. It's just because it's a 2-year loan, right, that you're making. So amortizing it doesn't really using the bank model of amortization doesn't make sense because there's only 2 years. All right. There's not enough payment cycles to do that. So instead, you charge a higher APR to make the money. And you do have to, so you don't want to give yourself this sweetheart deal either, again, because remember, if you ever get audited and you decided to charge yourself, 1% interest, well, the bank's going to be like, come on, that's not realistic. So what you want to do is you want to do everything above board. You want to be honest. You want to always have open books. You want to record everything. And that's what makes this strategy difficult. It's not difficult to actually execute. It's difficult because of how you have to keep track of your finances. You really, Ray and I, when we do this, we don't even do it ourselves. We actually have our accountant do, we set it up this way, but we have the professionals actually do all the numbers for us, do the math work for it. But look at what's happened right off the bat. So right off the bat, Max has got $25,000 in a loan, right? And at the same time, so that's going to really help his debt to income ratio right off the bat. At the same time, the business has picked up cash flow. So now both are starting to experience some benefit. Max has got some money to work with now, and the business has got some cash flow to work with. We're off to the races, folks. Let's see how else we can get this working. So I need to go ahead and stop my picture just for a moment so you can see what we're doing here. In your upper right-hand corner, what you should see is the credit banking curve that you normally see, right? So this is what it looks like on the corporate credit side. So where for the business on their lines of credit, they just gave $25,000. They just like racked it up to $25,000. Now, what's great on business credit is there is no utilization consideration. So people are like, "Oh my gosh, you just maxed out your card. Isn't that what got Max in trouble?" Well, yeah, on personal credit, you've got to stay below 50% utilization. But on business credit, they don't have that rule. So businesses can max out their credit at no penalty. It's another advantage of business credit. So immediately, $25,000, bam, is on the corporate credit card. But remember, you see Max. Every month he's putting $5,000 into this line of credit. So it's getting paid down. The expenses are going back onto this card as well, right? Because you got $3,000 of expenses, $5,000 down, $3,000 expenses. When you do that over and over again, it's paid off in 11 months. That $25,000 with the $2,000 cash flow is paid off in 11 months. So again, when I keep going back and forth. I'm talking loan, I'm talking line of credit loan. It depends on how you set it up, right? It just depends. If you're doing the loan route, then you're just receiving straight payments. So then it's not making that little jagged curve going down. It would just be a straight line coming down, right? But if you extend it as a line of credit, then it's going to have that jagged line to it. So let me start our camera back up because I want you to see our beautiful faces. That's what's most important. That and credit banking. So as you continue to work this down, if you're extending it as a line of credit, so you made Max an authorized user on the corporate credit card account for the business. And you know what's weird is, but doesn't Max own the business? Yes, he does. But when he uses the card for the business to make a legitimate business expense, that's different than if he extends a line of credit to himself personally to make purchases of a personal nature. This is why you've got to have documentation. And when you give Max the authorized card, there's now a record in the credit card statement that shows, well, this is what the main account paid for, and here's what the authorized user paid for. Now, the main account has to pay for all of it, but at least you now have it itemized out for you, right? Your accountants now love you that you did it that way, so that they can keep better records of it. So as you're paying this down, if you're using the line of credit method of extending the line of credit, Max puts $3,000 of expenses, then he pays it down. So it's all paid off in 11 months. But remember, this is a 0% interest card for the business for 24 months. So Max, he could max out another $25,000 and then sweep that down again. So Max, remember, he has two autos. He has his house, right? He's got his credit cards. Well, let's say with the first $25,000, he wipes out his credit card balances. Now those limits, they all drop, right? But at least that's zeroed out for him. He's freeing up that cash flow. Then let's say the other half of that he puts towards paying off one of the cars. So he's got one car paid off and he's got his credit lines reduced. He's freed up like $900 of cash flow, right? Just with that first shot. And so he's able to sweep this down in 11 months, paying this down. Now he gets another $25,000 for his next round, and he decides, you know what, I mean, it just depends on where he's at. So let's say he just puts all of that onto the house, you know, or he decides to pay off the car, does half. I'm going to put $12,000, pay off the second car, and then $12,000 onto the house. But he sweeps that all down in another 11 months.
That would be
amazing. Either way. So now he's freed up $1,200 of cash flow, and he's accelerated in 2 years. He's now moved ahead 4 years in time in his amortization on his house, he's probably saved somewhere around $30,000 in interest right now. So this is pretty amazing, folks. So all the while with the business now, let's go back to the business. What has happened with the business is this $25,000 corporate line of credit that was used every month over and over and over again. It has 24 months of positive activity, and it's always getting used and paid down. Well, it's not hard in 24 months, because every 6 months you can ask for a credit limit increase. On your personal side, that would cost you an inquiry. On the business credit side, it'll still cost you an inquiry, but guess what? Inquiries don't count against you. So every 6 months, you're asking for a credit limit increase on those cards due to your activity, and you get credit limit increases. It is possible to take $25,000 in corporate lines of credit over 24 months and grow that up to $150,000. I say up to because maybe you only grow it to $100,000. But if you have enough payment history and you're creating enough payment and you're making all your payments on time, and you've got a lot of, I mean, these accounts that you have, this might be over 4 or 5, maybe even 8 different accounts that you have. And so if you've got all this positive payment experience happening, this is going to look really good for the business. In fact, so good that you're going to notice that we just got ourselves our second star. Because the business, while we gained the initial business credit, we really didn't establish the track record of a positive payment history. So we were extended some initial lines of credit, some business credit, but then we used it the right way and we grew it to $150,000. We have the potential to grow it up to that much. So everybody's situation is going to be slightly different. We're using the numbers here in this example to show how you could reach 150,000, right? So now let's talk about the fact that how is this money secured? It's secured by the collateral, by the private mortgage note, the 2-year note at 30% interest in second lien position. What does that mean? That means that your business has equitable interest in your house. It has a tangible asset. In fact, it means that we've achieved the 3rd star, collateral. Your business now, for its books, can show revenue based off of its cash flow, right? It's got credit and it's got collateral. Now, that's great for the business, and you can use that to continue to grow and build this business, right? This is just the start. But what happened to Max? How did Max benefit? Well, his utilization went down, his debt to income ratio went down, and his credit score went up over these 2 years. So we turned that frown upside down. Max is now happy because his impossible situation is completely turned around. He's been using his lines of credit a little bit, and so he's growing those limits by being responsible, keeping his utilization under 30%, right? His debt to income ratio has gone down because he's eliminated his credit card debt. He's eliminated both of his auto vehicle debts, and he's brought the debt of his house down by another $12,000 in this 24 month period of time. So this has been absolutely huge. So he is absolutely reaping the benefits of doing credit banking with business credit. So when his credit score has now gone up, he's now in a position where, let's say his credit score, which was in the tank, maybe it was in the 400s, after this 2-year period of time, it would not be unheard of to be at 680 by now. He could be at 680, maybe 700 as a credit score. What can Max do with it? Well, he can now be in a position to give his business a personal guarantee. What does that allow him to do? It's like Max is going to co-sign for some more credit cards for the business. He can get with his personal credit score, right? If he grows those credit cards up, and he can, over the period of time, he can get the limits on those credit cards expanded. You know, we want to see 5,000, 10,000, right? If he's being responsible and utilizing the credit banking strategy as we've talked about, because this whole business credit with credit banking, we're done in 2 years. Max is able now to get going on his own, but now he can give a personal guarantee, and he can give up to another $50,000 and corporate credit cards with a personal guarantee. I say up to because, again, it's going to depend a lot on where Max's credit is. So during the 2 years where Max eliminated his the balances on his credit cards, he needed to make sure that he was using those credit cards every month, making small little purchases, staying under 30% utilization, and then every 6 months or so, trying to get his credit limit increased. Keeping in mind that if you ask for the credit limit increase, there will be you will get an inquiry. So you got to manage those inquiries well. It's okay to use an inquiry if you're going to get something for it, but again, a lot of moving parts here. But if, let's say Max got those credit lines over 2 years up to, say, 10,000, 15,000 limits, so he got them back, and he's got them back because he's now using his credit the right way, and every 6 months he can ask for a credit limit increase because he has the payment history to justify it. He could get up to $150,000. Maybe he only gets 100, maybe he only gets 75,000. But whatever that is, that's additional credit that now the business can use, right? And because the business is building business credit, and it's got that gold star by the credit, the business has the ability, after establishing a positive payment history of 6 months with the new line of credit, to get the personal guarantee removed. There's a couple of ways to do that. We're not going to cover that now, but this is how you do business credit with credit banking. A lot of different ways to do it. You can do it as a loan, do it as a line of credit. You can collateralize a house. You can collateralize really anything that has over a $10,000 value legitimately. But man, this is business credit with credit banking. The thing is most people, they're familiar with debt. They're familiar that they've got financial problems. They need a solution. This is abundance mindset thinking right here. If you can see the power of starting a business to help yourself out and relieve your financial woes, at the same time build and grow a legitimate success. Now in this example here, you have a business with $300,000 in access to corporate credit. This business could just go ahead and pay off the rest of your mortgage and then legitimately have a first position home equity line of credit on your house that you paid for, right? And the business has more collateral, it has more credit, it now is going to get more cash flow from you, and you get more write-offs. There's so many different advantages here. But here's the point of why we do it this way, because when more people get to become business owners and they need to implement these strategies, this is what we do. So I'm a real estate investor, and so is Mr. Ray Fleming here. And we have spent our lives looking for people to invest in our lives. We spent the last 6 years looking for investors to invest in our businesses, and we have, and it's wonderful. But what we've noticed is a lot of folks that we've worked with, and there's many that want to do this, but they're max, and maybe you're max. And so we had this epiphany one day when we were building business credit, and we were just having so much fun putting this together, and we were just realizing that nobody else is doing this. Mm-hmm. But if people were doing this, they would be eliminating their problems. And so then the idea came, well, Ray, what if we help as many people as we can for free get out of their financial situations and put money in their pocket and help them become wealthy, financially free? How many of those people might return back to us as future investment partners, as people who would be money lenders to us and our business deals, people who would hire us to help them do their business credit portion of their business? That is the whole foundation of why we do this. We have to prove to you that we have value to offer you. We have to show you that we can do this, we can help you. And by helping you now is basically like us putting our resume out there, so that when you do run into a situation where, well, I do need a business, I do need business credit, I do need help with this, behind this. And so if we can give you guys a lot of opportunities to change your life, like it's changed my life, like it's changed Ray's life, then we might find, and this isn't going to be everybody, but we might find that there's something else that we could do together. We had this one single mom we worked with who was like over $100,000 in debt. And we implemented a business credit banking strategy, eliminated all of her debt, and now has like $50,000 in lines of credit. And all that debt that we eliminated was still credit. I mean, she's gone on to become a real estate investor and has done something like, what, 4 properties in the last 2 years.
Oh, yeah.
And made $30,000 profit.
That's awesome.
So on top of that, with her lines of credit, as a single mom, I mean, so there's no excuse. People are like, well, you don't understand my situation. Like, yeah, we have a lot of people that are in your situation.
We like that.
Because everybody is Max. That's why I do. Because Max, and this, just so you know, Max was me. All right? I was Max. Folks, I want to thank you so much for being here tonight. Look, people are feeling that the economic times are hard. They're feeling pinched. They're feeling squeezed. Some people have been downsized, right-sized, homogenized. I mean, people just feel like everything is going sideways. And I just want to let you know that we're right there with you. We're all in this together. But the thing that's going to separate us, you out there and us here, is that we have the map, we have the strategy, we have the plan to get out of here. You see, we're not going to wait for people in Washington, D.C. to come solve our problems, because that's a long wait for a train that's never going to show. What we're going to do, and what we are doing, is we're creating our own economy. We're creating an economy that we can control. And when we do that, we're going to have the confidence to move forward in pursuit of our dreams. Life, liberty, and the pursuit of happiness. That's what we really want to help extend to each and every one of you that are out there. All right, so if that's you and you're thinking to yourself, man, this is where I want to be, this is what I need to get that business strategy. How do I create the business HELOC with my personal finances? How do I get business credit and combine that with credit banking? You need to contact the Wise Guys in Ties, right? So call us or go to our website and schedule a free consultation. If you're in the YouTube or you're in webinar, Ray has put contact information for you to reach us there as well. So folks, on behalf of myself, Joseph Smith, this is my business partner, Mr. Ray Fleming.
Good night, everybody.
Good night, and God bless.